Washington takes a step back from the brink. For weeks, the U.S. government shutdown has felt like a slow-burning crisis, not loud enough to dominate every headline, but dangerous enough to quietly weaken confidence across the economy. Now, Washington may finally be stepping back from the edge. The U.S. Senate has advanced a bill designed to end the shutdown, clearing a critical procedural hurdle with just enough votes to overcome a filibuster. Several Democratic senators crossed party lines, signaling that political pressure is mounting to stop the damage before it spreads further. If fully passed, the bill would fund the government through late January and limit the president's authority to fire federal workers. But more importantly, it would restore something the economy desperately needs right now: visibility. A prolonged shutdown doesn't just affect federal employees, it disrupts air travel, delays economic data, and creates uncertainty for businesses, investors, and retirees alike. Airline cancellations have already surged, and transportation officials warned that if the shutdown extended into peak travel season, disruptions could escalate rapidly. Markets reacted immediately to the Senate's move. Global stocks turned higher, not because investors suddenly feel optimistic, but because they see a chance to avoid a worst-case scenario. For older Americans, this moment matters. Government data guides interest rates, Social Security planning, and retirement investment decisions. When the government shuts down, those signals go dark, and uncertainty fills the gap. This vote doesn't end the crisis, but it does suggest that lawmakers are beginning to recognize the economic cost of inaction. For now, the shutdown's grip may be loosening, but the underlying risks remain. The hidden economic damage of a government shutdown. While political leaders debate budgets and blame, the real cost of a government shutdown shows up quietly, in places most Americans don't see right away. One of the earliest warning signs has been air travel. Since the shutdown began, thousands of flights have been canceled or delayed across the country. Transportation officials have warned that if funding disruptions continue, staffing shortages and operational strain could worsen dramatically. At one point, officials even cautioned that if the shutdown stretched into the Thanksgiving travel season, the U.S. aviation system could grind close to a halt. That's not just an inconvenience, it's an economic signal. Air travel disruptions ripple outward, hurting tourism, delaying business travel, and raising costs for airlines already operating on thin margins. For consumers, it means missed connections, higher prices, and growing frustration. But transportation is only one piece of the puzzle. Behind the scenes, the shutdown has frozen key government functions that support the broader economy. Contractors go unpaid, permits are delayed, regulatory decisions are put on hold. Each delay adds friction to an economy that is already slowing. Even the White House has acknowledged that the economic impact of the shutdown has been worse than initially expected. Growth estimates have quietly been revised down, and consumer confidence has taken another hit. For older Americans, these disruptions matter more than headlines suggest. Travel plans, medical appointments, family visits, and even holiday schedules can all be affected. And when daily life becomes less predictable, financial caution tends to rise. The longer a shutdown lasts, the harder it is to reverse the damage. Some losses are never fully recovered. They simply fade into lower growth. This is why markets reacted so strongly to even a hint of progress in Washington. Avoiding further harm has become the markets react, relief rally, or false signal. As soon as news broke that the Senate had advanced a bill to end the shutdown, financial markets wasted no time reacting. Across Asia, Europe, and the United States, stock markets turned higher. Futures climbed, technology shares led the gains, and the mood shifted, at least on the surface. But this rally wasn't driven by confidence. It was driven by relief. Investors weren't celebrating strong economic data or improving fundamentals. They were simply responding to the possibility that a damaging political standoff might finally end before causing deeper harm. That distinction is critical. Relief rallies are often short-lived. They reflect emotion, not long-term conviction. When markets rise because something bad didn't happen rather than because something good did, the foundation is fragile. For retirees and long-term investors, this kind of market behavior should prompt caution. A green screen can feel reassuring, but it doesn't mean risks have disappeared. Inflation pressures remain, growth is slowing, political uncertainty is still very much alive. Technology stocks once again did most of the heavy lifting, especially companies tied to artificial intelligence and advanced computing. But concentration cuts both ways. When markets depend on a narrow group of stocks, any shift in sentiment can have an outsized impact. The message from markets is subtle but important. Investors are desperate for stability, not convinced that it has arrived. This rally may buy time. It does not buy certainty. Why technology stocks are carrying the market? As broader economic signals weaken, one sector continues to do the heavy lifting for global markets: technology. From Wall Street to Asia, tech stocks have become the backbone of recent market gains. Investors searching for growth in an uncertain environment have crowded into a familiar group of names: companies tied to artificial intelligence, cloud computing, and advanced semiconductors. The logic is straightforward. When economic growth slows, investors gravitate toward businesses they believe can grow regardless of the cycle. Technology, especially AI-related technology, is seen as a long-term structural trend rather than a short-term economic bet. But this concentration comes with consequences. A handful of large tech companies now account for a disproportionate share of market gains. That means market performance increasingly depends on the continued optimism surrounding just a few themes. If confidence in those themes wavers, the entire market can feel the impact. For older Americans and retirees, this matters deeply. Many retirement portfolios are now far more exposed to technology than they were a decade ago, often without investors fully realizing it. Index funds and target date funds have quietly increased tech weightings as these stocks have grown larger. There's also a valuation issue. Technology stocks are no longer cheap, expectations are high, and earnings must continue to justify today's prices. Any disappointment, whether from regulation, slower growth, or rising costs, could trigger sharp pullbacks. Technology is driving the market forward, but when one engine pulls too much weight, even a small misfire can cause turbulence, and that's a risk investors cannot afford to ignore. Semiconductors at the center. Demand is not the problem. At the heart of today's technology-driven market sits one critical industry: semiconductors. Chip makers have become the foundation of everything from artificial intelligence to cloud computing and advanced defense systems. And right now, demand for advanced chips has rarely been stronger. Taiwan Semiconductor Manufacturing Company, or TSMC, offers a clear snapshot of the situation. The company recently reported nearly 17% year-over-year revenue growth, reaching close to $12 billion in quarterly sales. On the surface, that sounds impressive, but there's an important detail investors shouldn't miss. This was actually the slowest growth rate TSMC has posted in the past 18 months, not because customers are pulling back, but because production simply can't keep up with demand. Major clients, including NVIDIA, have openly stated they are asking for more advanced wafers to support booming AI workloads. TSMC, however, is operating near capacity. Building new fabs takes years, not months, and costs tens of billions of dollars. For markets, this creates a delicate balance. Limited supply allows chipmakers to maintain strong pricing power, but it also caps how fast revenues can grow and increases vulnerability to disruptions, whether from geopolitics, trade tensions, or natural disasters. For retirees and conservative investors, the message is nuanced. Semiconductors remain essential and profitable, but expectations may be running ahead of what the industry can physically deliver in the near term. Strong demand alone does not guarantee smooth returns. When supply is the bottleneck, even the best-positioned companies face limits. AI valuations under pressure. When expectations peak, artificial intelligence has become the market's favorite growth story, but that popularity is starting to create pressure. Recently, fears of an AI bubble erased more than $1 trillion in market value from major technology stocks, including NVIDIA and Meta. The pullback was swift, reminding investors how quickly sentiment can change when expectations run too far ahead of reality. The concern isn't whether AI will reshape the economy. It almost certainly will. The concern is whether today's stock prices already assume years of flawless execution. Valuations across leading AI companies are stretched by historical standards. Many are trading at levels that leave little room for disappointment. At the same time, costs are exploding. Building and operating AI infrastructure requires massive investments in data centers, chips, energy, and cooling systems. There's also a structural shift underway. Tech giants like Alphabet, Amazon, and Meta were once praised for being asset-light. Today, they are becoming increasingly asset-heavy, tying up capital in physical infrastructure that must deliver returns over time. For retirees, this matters more than headlines suggest. When expectations peak, markets become unforgiving. Even strong earnings may not be enough if growth slows or margins tighten. History offers a warning. Transformative technologies often deliver long-term value, but not in a straight line. Investors who confuse innovation with guaranteed profits can find themselves exposed at exactly the wrong moment. AI remains powerful, but power does not eliminate risk. From AI to quantum, a new speculative frontier. As enthusiasm around artificial intelligence begins to cool, investor attention is already shifting to the next frontier, quantum computing. Over the past year, a group of relatively small and little-known quantum companies has seen their stock prices surge dramatically. Names like Rigetti, D-Wave, and IonQ have posted gains of hundreds, and in some cases, thousands of percent. For many investors, the move feels sudden. For others, it feels familiar. Quantum computing promises to solve problems that are practically impossible for today's classical computers. From advanced cryptography to drug discovery and financial modeling, the potential applications are enormous. That promise alone has been enough to ignite speculation, but speculation is the key word. Most quantum computing companies today generate very little revenue. Many are still operating at a loss, relying on investor funding to survive while the technology matures. Their machines are experimental, expensive, and limited in real-world usefulness, at least for now. So why the excitement? Part of the answer lies in timing. With AI valuations stretched, investors looking for the next big thing are willing to take risks further out on the horizon. Quantum fits that narrative perfectly, revolutionary, complex, and still early. For retirees and conservative investors, this shift should raise caution flags. Early-stage technologies can deliver extraordinary returns, but they can also deliver sharp losses when optimism fades. Quantum computing may shape the future, but today's market is trading more on hope than on hard results. When quantum becomes real, the race to quantum advantage. Behind the soaring stock prices and bold predictions, there is one phrase that truly defines the future of quantum computing: quantum advantage. Quantum advantage refers to the moment when a quantum computer can solve real-world problems faster, cheaper, or more efficiently than even the most powerful classical supercomputers. According to industry leaders, including executives at Rigetti and IonQ, that milestone is still 3 to 5 years away, and the road to get there is steep. To reach quantum advantage, systems must scale to roughly 1,000 qubits, while dramatically reducing error rates. Today's machines operate with far fewer qubits, and even small error margins can overwhelm calculations. Experts point to a critical benchmark, achieving 99.9% accuracy in 2-qubit gate operations, a level that remains just out of reach. Some progress is being made. Companies are experimenting with modular architectures, often referred to as chiplets, which could allow systems to scale more efficiently. But error correction remains the industry's greatest challenge, requiring both technical breakthroughs and massive investment. For investors, especially retirees, this timeline matters. Markets often price success years in advance, but technological breakthroughs rarely follow predictable schedules. Delays are common, costs escalate, expectations reset. Quantum advantage, when it arrives, could transform industries from finance to healthcare. Until then, quantum stocks remain a bet on patience, funding, and scientific progress, not guaranteed outcomes. The promise is real. The timing is uncertain. And in markets, timing is everything. Inflation signals reappear. What markets are telling us? As Washington debates stimulus and technology investors chase future growth, financial markets are quietly sending a familiar warning. Inflation concerns are resurfacing. Following news of the proposed $2,000 tariff dividend and signs that the government shutdown may end, investors began repositioning. Gold prices moved higher. Cryptocurrencies saw renewed buying interest. Even U.S. Treasury yields edged up. These moves may seem subtle, but together they tell a clear story. When markets anticipate more money flowing into the economy, whether through stimulus, tariffs, or fiscal spending. Investors start protecting themselves against the possibility that prices will rise faster than incomes. Gold has long served as a hedge against inflation. For some investors, digital assets now play a similar role, reflecting concerns about currency value and policy credibility. Rising Treasury yields add another layer of complexity. Higher yields can be good news for savers who rely on interest income, but they also signal expectations that inflation may remain stubborn or even accelerate. If inflation rises faster than yields, real purchasing power still declines. For retirees, this environment is particularly challenging. Fixed incomes offer stability, but they are vulnerable when everyday costs increase. Groceries, healthcare, insurance, and utilities rarely wait for cost of living adjustments to catch up. Markets are not panicking yet, but they are adjusting to a world where economic stimulus, political pressure, and limited supply chains may collide. Inflation doesn't usually return with a shock. It creeps in quietly, and right now the signals are getting harder to ignore. The Federal Reserve's toughest balancing act. As inflation signals begin to reappear and economic growth shows signs of slowing, the Federal Reserve finds itself in one of the most difficult positions it has faced in years. On one side, parts of the U.S. economy are clearly losing momentum. Hiring has cooled, business investment has slowed, and consumer confidence remains fragile. Markets are pressing the Fed to respond, hoping for interest rate cuts to support growth and asset prices. On the other side, inflation risks refuse to fade. Potential stimulus measures, ongoing tariffs, and supply constraints all threaten to push prices higher again. Cutting rates too quickly could reignite inflation, eroding purchasing power for millions of Americans, especially retirees living on fixed incomes. Complicating matters further is the lack of reliable economic data. The government shutdown has delayed or halted the release of key indicators, leaving policymakers partially blind. Decisions that normally rely on clear data must now be made with incomplete information, increasing the risk of policy mistakes. There is also the question of independence. Financial markets have become highly sensitive to any sign that political pressure could influence the Fed's decisions. Past concerns about lost independence have already fueled volatility in the U.S. dollar and bond markets. For older Americans, the stakes are personal. Interest rates affect savings returns, bond income, borrowing costs, and the overall stability of retirement portfolios. The Fed's challenge is not just technical, it's strategic. Every move carries trade-offs, and right now, there are no easy options left. The U.S. labor market, slowing, not breaking. Despite growing concerns across markets, the U.S. labor market is sending a more nuanced signal than many headlines suggest. According to private payroll data from ADP, job growth is continuing, but at a noticeably slower pace. Companies are still hiring, yet they are doing so cautiously. The era of aggressive expansion appears to be over, replaced by a more defensive mindset. Importantly, this is not a wave of mass layoffs. Most Americans who currently have jobs are still holding on to them. That's the good news. The bad news is what happens if a job is lost. With fewer companies actively hiring, finding new employment has become significantly more difficult. Job searches are taking longer, and in many cases, new positions come with lower pay or fewer benefits. This shift is especially challenging for older workers nearing retirement age who may face age bias or limited opportunities to re-enter the workforce. Economists point to a deeper issue: declining economic dynamism. Fewer new businesses are being formed. Expansion plans are being delayed. Wage growth is slowing. These trends suggest an economy that is gradually losing energy rather than collapsing outright. For retirees and those approaching retirement, this environment increases financial vulnerability. Unexpected job loss late in a career can derail retirement timelines and strain savings at the worst possible moment. The labor market isn't breaking, but it is bending, and history shows that when momentum fades long enough, pressure eventually builds. Missing data and market anxiety. Flying blind, one of the least visible, yet most dangerous, consequences of the government shutdown is the loss of reliable economic data. When federal agencies shut down, key reports simply stop. Employment figures from the Bureau of Labor Statistics are delayed. Inflation updates become incomplete. Industry surveys go quiet. And suddenly, the entire financial system is forced to operate with blurred vision. Markets do not handle that well. In the absence of official data, investors turn to private sources such as ADP payroll reports. While helpful, these numbers are not perfect replacements. They tend to track government data over time, but they lack the depth, consistency, and authority policymakers rely on. For the Federal Reserve, this creates a serious problem. Monetary policy decisions are built on data. When the data disappears, decisions become riskier. A rate cut or pause made with incomplete information increases the chance of overshooting, either reigniting inflation or choking off growth unnecessarily. For retirees, missing data translates directly into volatility. Markets become more sensitive to rumors, headlines, and single comments from officials. Price swings grow sharper. Confidence weakens. Perhaps most troubling is what the missing data hides. Economic stress does not stop during a shutdown. It simply becomes harder to measure. Slowing hiring, rising prices, and weakening consumer sentiment continue beneath the surface. When markets lose clarity, fear fills the gap. And when fear rises, even stable investments can feel unstable. Earnings season, numbers versus narratives. As political uncertainty and technology speculation dominate the headlines, earnings season brings markets back to something far more concrete: corporate results. With more than 90% of S&P 500 companies having reported, roughly 82% have beaten earnings expectations. On the surface, that sounds like a strong showing. But the details tell a more cautious story. Many companies are beating expectations that were already lowered. Revenue growth is slowing. Cost pressures remain elevated. And forward guidance, the outlook executives provide for the months ahead, has become increasingly careful. Investors are listening closely not to what companies earned last quarter, but to what they say comes next. Major firms like Disney, Cisco, and CoreWeave are under particular scrutiny. Their results offer insight into consumer demand, enterprise spending, and the health of the technology infrastructure boom. In several cases, management commentary has been more restrained than the headlines suggest. Veteran investors know this pattern well. When markets rally on optimism, earnings season often acts as a reality check. Strong narratives can lift stock prices for a time, but sustainable gains require consistent profits and believable forecasts. For retirees, this distinction matters. Markets built on stories tend to be more volatile. Markets built on earnings tend to be more durable. High valuations demand near-perfect execution, and any stumble can trigger sharp corrections. Earnings don't lie forever. Eventually, the numbers catch up to the narrative. And when they do, markets are forced to adjust, sometimes quickly and sometimes painfully. Trump's $2,000 tariff dividend, stimulus or strategy? Just as markets attempt to digest earnings results and political uncertainty, President Trump has introduced a proposal that immediately grabbed national attention: a $2,000 tariff dividend check for American households. The idea is simple, at least on the surface: use revenue generated from tariffs to send direct payments to Americans. Supporters argue this would stimulate consumer spending, support economic growth, and demonstrate that tariff policy can benefit everyday citizens. But the timing has raised eyebrows. The proposal comes amid a government shutdown, softening economic momentum, and growing concerns about voter sentiment. Critics question whether the dividend is economic policy or political messaging designed to calm markets and consumers. Financial markets reacted quickly. Gold prices ticked higher. Cryptocurrencies saw renewed interest. Treasury yields edged up slightly. Together, these moves suggest that investors are thinking less about short-term spending boosts and more about longer-term inflation risk. For retirees and older Americans, this distinction is critical. A one-time check may provide short-term relief, but if it contributes to higher inflation, the long-term cost could outweigh the benefit. Fixed incomes are especially vulnerable when prices rise faster than cost of living adjustments. There's also the issue of sustainability. Tariff revenue can fluctuate with trade flows, global demand, and policy changes. That makes it an uncertain foundation for ongoing economic support. The tariff dividend proposal may sound appealing, but beneath the surface, it raises complex questions about inflation, policy priorities, and who ultimately pays the price. The big picture. What this means for older Americans. When all the pieces are put together, the government shutdown, market relief rallies, technology speculation, inflation signals, and political stimulus proposals, one reality becomes clear: The financial landscape is growing more complex and less predictable. For older Americans and retirees, this environment demands a different mindset. Short-term market moves can be noisy and misleading. A rally sparked by political relief does not guarantee lasting stability. Excitement around AI or quantum computing does not eliminate valuation risk. And one-time stimulus checks do not solve long-term cost of living pressures. Inflation remains a quiet but powerful threat. Even modest increases in everyday prices can slowly erode purchasing power over time. Fixed incomes, no matter how carefully planned, are vulnerable when inflation outpaces adjustments. At the same time, slowing economic momentum and a cooling labor market reduce flexibility. Late career disruptions are harder to recover from. Investment mistakes take longer to repair. And volatility feels more personal when retirement security is on the line. The goal in this environment is not to predict every headline. It's to build resilience. That means understanding where risk is rising, recognizing when optimism may be overstated, and avoiding decisions driven by fear or hype. Markets will continue to change. Policies will shift. Technology will advance. But for retirees, the priority remains constant, protecting financial stability while allowing for careful, measured growth. In uncertain times, clarity and patience become the most valuable assets of all.